Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. On September, let me say this, we have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet. If we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain. Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it, and then how is that affecting the outlook, and how is it affecting the balance of risks? That's going to be the assessment that we do. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves. Just to make it clear, it's a very difficult, challenging judgment, and we didn't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Hi, Victoria Guida with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more, if it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today. I would also say some people examine the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in. More broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet.